Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures little changed this morning as investors eagerly await Nvidia results out after the bell. The AI chip giant marks the final stock of the Magnificent Seven cohort to report its earnings. Investors will be closely watching sales of its Blackwell chips, which faced manufacturing issues in the fourth quarter, as well as profit margins, as Nvidia said the cost of ramping up its Blackwell production could weigh on gross margins. Shares of the world's most valuable chipmaker have soared over 40% since its April lows, but are less than 1% up on the year.
Plus, retail earnings front and center this morning as well. Macys posting better than expected quarterly results as the department store's strategy of focusing on its best performing locations is showing signs of paying off. While the company did cut its profit outlook for the year, it's maintaining its sales guidance. Meanwhile, Dick's Sporting Goods maintaining its sales and profit forecast for the year as the company prepares to acquire Foot Locker for $2.4 billion.
And Elon Musk's SpaceX facing a setback. In the latest test flight for its Starship vehicle, the company lost control of the vessel and was unable to deploy its satellite monitors. This comes after the previous two Starship test missions ended with explosions. In a post on X, the company said the spacecraft came apart. Musk said on X after the flight ended that leaks caused the spacecraft's main tank to lose pressure. He said there was a lot of good data that SpaceX would continue to review.
Nvidia first quarter earnings due out after the bell today. Yahoo Finance tech editor Dan Halley is here now with the key things to watch for in the report. Dan, what are the things that are kind of pillars to what we need to hear from Nvidia?
Yeah, I think how they're dealing with the China situation and obviously overall data center sales. And so let's just go over the numbers real quick that we're expecting. We're looking for earnings per share of 88 cents on revenue of 43.3 billion. That would be up from the 61 cents last year in the same quarter and 26 billion of revenue. Now, as far as data center goes, we're looking at 39.2 billion. That would be up from 22.5 billion, 75% year over year increase. And then the, formerly largest aspect of this business, gaming, is set to go to 2.8 billion. That would be up from 2.6 billion. But really what we want to focus on is China, and that's because of the bans that the Trump administration put in place for NVIDIA's H20 chip. Now, that chip was originally created for the Chinese market, specifically because they weren't allowed to sell more powerful chips than that. So they built the H20. They had built a prior chip before that as well, but now both of those exceed the kind of limits that are in place on these chips to be sold. And so for revenue out of China, it's going to be interesting. Expectations for 6.2 billion, that would be up 150% since the same time last year. Obviously the US, its largest market, 21.6 billion. But what does that mean then now that the H20 isn't available for NVIDIA going forward and for this quarter? Well, NVIDIA had released a statement saying that they're going to have to take a $5.5 billion charge on the H20 chips that they had already prepared and orders, things along those lines. So that's going to be an issue. We'll be on the lookout for whether or not Jensen Huang, CEO, says anything about a newer chip. There's been reports from Reuters that they're working on a successor to the H20. And if that allows them to continue to operate in the Chinese market, Jensen has said in the past that if NVIDIA is unable to participate in the Chinese market, it gives Chinese companies a leg up because naturally they're going to go for what's ever available, and saying that that undermines Washington's attempts to ensure that the U.S. has AI supremacy.
Yeah, and Dan, it's interesting. I think the sentiment across Wall Street here is a bit subdued. Bank of America saying second quarter guidance could be messy. Piper Sandler expecting the company to miss on revenue. But both of those firms and more broadly across the street, there's still bullishness longer term on NVIDIA. What does Jensen Huang have to deliver today in order to shift the near term sentiment on this stock?
Yeah, I think he has to show that Blackwell is selling very well, that they're getting it out to customers, that they continue to see increased demand. I think playing up the obvious deals that they had announced in the Middle East with Saudi Arabia and the United Arab Emirates, those will be opportunities to say, look, there's still the ability to get at these kind of big deals that people are still looking for. And so, I think part of the issue here is that Nvidia has been the hot topic for a bit, but that doesn't mean that everyone that wants AI chips has gotten them. There's still a huge demand. And if you look at the hyperscalers, they'll say, look, we have more demand than capacity, so we don't have enough chips. So how is NVIDIA ensuring that those customers get it? And then I think one of the things that's often overlooked is they regularly say that roughly 50% of their revenue comes from these hyperscalers. How are they diversifying beyond that, right?
Yeah.
Like, where else are they going to be getting their revenue that matters? And so that's where that idea that Jensen has been pushing about sovereign AI really matters with, the Saudi investment in United Arab Emirates. That's the idea there, that these countries are making these purchases and ensuring that NVIDIA has more room to grow.
Especially as their customers start to also become competitors as the hyperscalers work on their own chips, as you know. Dan, thank you so much. I know you got a busy day ahead, so we appreciate your coverage in advance. Thank you. Well, Nvidia is not the only AI play on Wall Street, of course, as the trade broadens out to include data centers, energy, and much more. Joining us now, Joe Tigay, Rational Equity Armor Fund Portfolio Manager. Joe, great to speak with you here. I'm curious, we are looking to Nvidia earnings here, and the market is widely anticipating this stock's results, but which stock within the AI space do you anticipate moving most directly off the back of Nvidia earnings?
Yeah, I guess it depends on exactly how they report it and what parts of their company are doing well or poorly. If we're just talking about more the need for more data centers, like the lack of supply of these data centers, then there are a few names that will do quite well. I'm thinking Broadcom is going to be a big part of that build out too. So yeah, there's plenty of other names in this space, not just Nvidia, that are going to live and die in this. One of the auxiliary companies to Nvidia is Nebius. They are buying a lot of the big Blackwell boxes that are making these hyperscale data centers. So they potentially could move depending on what we learned about how many are sold. So it's going to be very interesting to see their response to the result too. But yeah, it's fascinating to see. And in the energy space, I'm actually watching CEG. It's a company that's looking to restore some nuclear power plants, looking to get into more nuclear power play, because there is a big auxiliary play here next to the data centers. Is they're going to take a lot of energy, so there's going to be a need to supply that power. So there's certainly just a wider aspect to push us forward. It really just goes to the bigger picture that, for the past couple of years, this market has just been driven by this tech recovery. This tech cycle, this tech boom has really lifted a lot of these ships. There's a lot more that's going to be lifted up by all these chip sales.
Yeah, you mentioned the data center component as well to all of this, and data center construction contributing 1 percentage point to GDP growth, as I was looking through Torsten Slok, Apollo chief economist's note this morning here. As you're talking about some of the other plays that are non-NVIDIA, but still very much beneficiaries of the broader kind of AI thrust that we've seen and the hyperscaling, one of the other areas that investors have been trying to look at is the cloud services providers and what the recurring revenue run rate could look like because of all of the investment that's going to be coming forward, but also some of the services that are going to be regularly needed to be paid for as well. How are you identifying that part of this trade?
Yeah, that's a great point. I think Google's planting their flag in that too. They want to have a stick of that recurring revenue because they want to have, got the Gemini Ultra, Gemini Plus, and I think their report last week really got the market excited, just kind of showing like what the possibility are. Even with the economic headwinds we've seen this year, the uncertainty with tariffs, the race for AI leadership is just getting bigger and bigger. It's just expanding. So this is proving to be, it's not discretionary spending. These companies aren't just having some fun with this. This is like an imperative for their business future. Absolutely. So the underlying urgent demand for NVIDIA chips is out there. And you're making a great point. This recurring revenue, this could finally be where this AI is starting to make these big Mag 7s some profit. I think Google with this Plus and Ultra out there. I think that's a key test case for that because they really are kind of, I think they're in the lead right now. They were behind ChatGPT for me. Like, it was a stumble out of the starting gate for Google with, I think it was Bard, and I think they fixed that. They figured that out, and now this is really cool. I think people are looking at the Veo 3 and saying this is really amazing. So yeah, I think people are going to be willing to pay some money up front for that, especially maybe some smaller companies that are just trying to get in on the sidelines to see what AI can do for them.
Let's talk about ARM as well. This is another company. The stock is up over 55% since its April lows, but up just about 4% year to date. Talk to me about how you're thinking about the path forward for a name like ARM.
Yeah, they want to be in there. They want to be a competitor with Nvidia, but they also have a lot of other parts that are really crucial to these data center build out too. So yeah, I think it's just another part to the chip play. If Nvidia is crushing it, if Nvidia is selling as much as they can possibly make, ARM is going to do quite well with this too. So it's something to watch too. And now, if they're on the other side, if there's just a slowdown in demand, if they're not selling as much as thought, ARM of course will get hit just as hard.
Just lastly, as you kind of evaluate what's taking place on the geopolitical front and how this can also have a major impact on the early success and the long-term kind of run for all of the investments that are coming from different parts of the world as well, and strategic partnerships that are coming about there. Is there one specific region where you're seeing, or a combination of regions that are going to be key to the AI trade panning out to the same type of shareholder returns that we've seen over the past 2 years?
Like domestically region, or are you talking about
internationally?
Yeah, so I mean, it seems like a lot of these parts are coming from different all over the world. We know China has some very important rare earth metals, which are critical to a lot of the chip making process. So that's an interesting dynamic. They have like the raw materials, we have the finished good, and how do we share that with each other, knowing that we are conflicting in so many other ways. Europe actually has one of the biggest makers of the machines that make the machines. So in ASML, they have like they have an advantage there. So I think it's interesting that it is all connected. We can't really work without each other. But I mean, everyone's going to get their own share of the pie because everyone has a crucial component of that pie.
Joe, thanks so much for taking the time here pre-market. Appreciate it. We know you'll be watching the earnings later.
Yep. Thank you for having me.
Elon Musk's SpaceX facing a setback. In the latest test flight for its Starship vehicle, the company lost control of the vessel and was unable to deploy its satellite monitors. This comes after the previous 2 Starship test missions ended with explosions. SpaceX lost contact with Starship while conducting its 9th uncrewed test flight of the launch system, the most powerful ever constructed.
The spacecraft likely broke apart over the Indian Ocean after losing control upon re-entry to Earth. In a post on X, the company said the spacecraft came apart. Musk adding on X that after the flight ended, leaks caused the spacecraft's main tank to lose pressure. He said there was a lot of good data that SpaceX would continue to review. The spacecraft made it farther into its flight path than in previous tests this year, but it, of course, was not able to accomplish a couple of key objectives here. We're going to have all your markets action ahead here on Yahoo Finance. Stay tuned ahead of the opening bell on Wall Street. You're watching Morning Brief.
Now time for some of today's trending tickers. We are watching Abercrombie, GameStop, and Capri Holdings. First up, Abercrombie surging after raising its full-year outlook. The retailer also reporting better than expected first quarter results as it draws in more shoppers. Take a look at shares up 28% on the back of this earnings report here. A couple of things, though, to call out here, and I don't want to kind of take all of the wind out of their sails here, but thinking through some of the segment revenue here, you actually did see some declines for Abercrombie. Hollister, though, putting the team on its back with growth there of about 10.5% during the quarter. And then same-store sales, this was interesting because net higher by about 37%, but Abercrombie was a pretty big drag, at least within the same-store sales percentage declines that they had seen. So that is something worth keeping an eye on. Also, the inventory growth. Clearly, they were trying to front-run some of the impacts of tariffs I think that number came in at, what, 214% inventory growth year over year.
Yeah, well, and it's really important to note that the stock, at least prior to this print on Tuesday's close, was down over 45% year to date, obviously making up a lot of those gains right now. Having said that, it's interesting that in their guidance, they note a $50 million hit due to tariffs. It seems like investors are happy to at least have that clarity from the company. The forecast, including the estimated impact on tariffs of goods coming in from China and all other global imports, that 10% baseline tariff, but it did not include the current reciprocal tariffs that the president announced on his so-called Liberation Day on April 2nd. So those are obviously being negotiated right now. Abercrombie did not take that into account. They did take into account a 30% tariff on Chinese imports and a 10% baseline tariff, and the street obviously applauding their ability to do that, but it is fascinating that they're getting such a pat on the back when nobody has clarity on those so-called reciprocal tariffs at this point in time. All right, next up, GameStop is announcing a crypto purchase acquiring 4,710 Bitcoin. This is the first publicly acknowledged Bitcoin purchase by GameStop since the company did announce plans to move into Bitcoin investments back in March. Shares up a little over 1.5% here, but really interesting. And we've talked with sources about this on the show previously, Brad, the idea that GameStop is sort of trying to position itself as a Bitcoin company going forward. And what is that going to look like, especially given that they've gone through so many iterations, obviously a consumer-facing company and then a meme stock and now potentially the next crypto giant.
Yeah, hit the strategy button here. And at the end of the day, as you think about all of the companies that are trying to figure out, okay, on our balance sheet, how much of the investor story and the sentiment is also something that in this Venn diagram might cross over with some of those who are also Bitcoin holders too. The gamers out there are some of the earliest adopters to cryptocurrency. And so it seems right that GameStop would make a move like this, but why not sooner? Why not earlier? But this is another effort to try and make sure that the stock could be tied into some of the moves of something, well, dare I say fundamental, like just the holdings of crypto here.
Yeah, absolutely.
Also here, we're tracking Capri Holdings cutting its fiscal 2026 outlook due to uncertainty around tariffs. Still, the Michael Kors owner topped fourth quarter revenue estimates as it's focusing on its turnaround plan. You're taking a look at shares here on the back of this, down by about 1.25% or 1.2% right now. One of the things that actually caught my eye within Capri and the results that we had seen here, the company also is still expecting total revenue of about $3.3 to $3.4 billion. EPS, earnings per share for 2026 of approximately $1.20 to $1.40. That's the range that they provided right now.
Yeah, lowering that annual forecast seems to be, of course, the sticking point, though they did have quarterly revenue topping estimates on some of their turnaround efforts. They are working to revive some parts of the business. And remember, of course, this comes after the attempted merger with the Coach parent company Tapestry last year that obviously did not go through. Having said that, some commentary from Capri's CEO I have up here saying they're confident in their ability to grow Michael Kors to $4 billion in revenue and Jimmy Choo to $800 million over time while restoring operating margins to the double-digit range here. And they did note, this is a really important check on the consumer, that buyers in North America have scaled back their spending on high-end goods, so perhaps seeing a little bit of an impact of that wealth effect there. And I should mention you can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Macys cutting its full-year profit outlook as tariffs and higher promotions hit the business. Still, the retailer topping first quarter expectations as it moves forward with its turnaround strategy. Joining us now, David Schwartz, Morningstar's senior equity analyst. David, going into the report, I know that you had a $24 price target on the stock. I am curious, though, you say in one of the headlines of your recent notes that Macys lacks competitive edge. Is the strategy to focus on successful stores going to be enough for Macys, and how are you viewing the results now?
I do think that the stock is undervalued. As you mentioned, my fair value estimate is $24. So actually, I think it's trading at about half of what it's worth. But Macys certainly is a troubled company, and that's reflected in the valuation right now. Macys is in the process of closing a large number of stores, closed a lot last year, closing more this year, will close more next year, to focus on the stores that are performing better. Now, we're not really seeing positive comps from those stores, so it's certainly, at this point, uncertain that Macys can really turn it around. But Macys does have some things that are working. Bloomingdale's and Blue Mercury are both performing much better than Macys. They've both had consistent positive same-store sales growth. While some of the Macy's stores are performing okay, others are definitely dragging down the total numbers. And so I think at this point, Macy's is maybe not even halfway through its turnaround plan. And so it's hard to know if it's going to work in the long run.
Should investors believe in this turnaround plan, Dave?
I think at this point, the stock is so cheap that you don't necessarily have to believe in it to own the stock. I know that there's a lot of skepticism about the department store model. It's a model that doesn't work anymore realistically. And Macy's is dealing with a business that was built for a completely different retail environment. And Macy's is having to transform how it operates and having to downsize considerably to work in this market. And it's not clear that those will be enough. Those actions will be enough to really turn it around. But I do think that there's value in Macy's, and that there's value in the stock right now, and that there is a place for Macy's in retail. This is a company that has a very large e-commerce business, for example. It doesn't get much credit for it because people still see this as largely a brick and mortar business, but Macy's does something like $7 billion a year in online sales. So Macy's does have a reason to exist, in my opinion. I think the stock is so cheap that it's worth looking at.
As a digital first business, if they are able to make that transition, knowing that some of the elements of this turnaround plan mean, to your point, looking across the retail footprint that they do have, brick and mortar, and saying, okay, what's profitable, what's unprofitable, where do we need to shrink square footage size so we have less overhead that we have to account for? A lot of that sounds like a Sears playbook as they were in their peak slippage years. And so all of that considered and seeing exactly what took place, how is this essentially going to avoid being a similar case as Sears while they make that digital transformation?
Well, one thing you could say is that Macy's still exists and Sears doesn't. So I guess you could say that Macy's did survive. And we have seen a lot of other department stores go under too, including Bon-Ton, for example, Lord & Taylor and Gordman's and others that have gone out of business in the last 10 years. And we're probably going to see more. I mean, for example, JCPenney probably doesn't really have a future. And so, Macy's, I think, does stand out. It does have a large number of private label brands that do very well. It does have a good selection of merchandise, and Macy's does reach a large number of consumers. It has a large customer base, has millions of credit card holders, and is still the anchor in a lot of malls. And so, I do think that Macy's can survive where others have disappeared. It's going to be a smaller company. Macy's will never get back to its peak revenues, which I think it hit about 10 years ago. So this is going to be a smaller company, but there are successful retailers that have far smaller revenue bases than Macy's does, and they maintain their profitability. I think Macy's can also be consistently profitable after it does this downsizing and these remodeling actions that it's making right now.
Let's talk about Dick's. In your notes, you mention, and given your star rating on the firm, I can tell that you have questions about the valuation. How does the Foot Locker acquisition impact how you're thinking about the valuation of Dick's going forward?
Yeah, it's hard to say because it's still early. The Foot Locker deal was just announced last week, and people are still trying to assess how it's going to impact Dick's in the short term and the long term. I was probably one of the few that actually thought that Dick's was quite overvalued when it was over $200 a share. I thought it was worth closer to $160. So when the stock fell after the Foot Locker deal, to me that was partly because Dick's stock was overvalued to begin with. I understand why Dick's stock where it was at such a high level, because Dick's has been performing extremely well in the last few years. The business has really transformed, and it's been outperforming everybody, certainly including Foot Locker. And so a lot of people are very unhappy that Dick's is combining with Foot Locker, which realistically is an inferior business. But I think that Dick's is buying it for a very fair price at about $2.5 billion for Foot Locker. This Foot Locker stock price has been way down. And so even though Dick's is paying a premium over where the stock had been trading, they're still, I think, buying it at a fair price at only about 6 times depressed EBITDA. And I think from Dick's management's perspective, they're able to buy Foot Locker here for a very attractive valuation.
All right, we are going to be watching closely as that deal looks to close. David, thanks so much. Appreciate it.
Thanks.
All your markets action straight ahead. Morning brief and the opening bell next. There you're taking a live look at the opening bell on Wall Street at the NYSE and at the NASDAQ, where Qualcomm is ringing the opening bell. Friend of the show, Cristiano Oman, ringing the opening bell at the NASDAQ. He's got some funfetti and the team behind him. And at the NYSE, LTC rings the opening bell there. That is a real estate investment trust, I believe. And you're taking a look at some great bell ringers on that side, too. Let's take a look at the major averages as we begin today's trading activity. The futures were pointing just barely lower here a few moments ago for the Dow Jones Industrial Average. And as you can see, opening cross, we open up flat just barely to the upside here. So some hyper waffling coming into the start of trade. And we are out the gates right now, but in positive territory. That's a good thing for right now. We'll see if we can hold on to those gains. The NASDAQ Composite, that's up by about 0.2% to begin today's trading activity. The S&P 500 also seeing 0.1% in gains to begin today's trade. Let's take a look at the sector activity. As of right now, early moments, of course, in trade. You've got XLV bringing up the caboose. We are mixed. Healthcare, though, that is down. Energy, that's leading the pack. That's up by about 0.7%. And as of right now, it looks like we have just one more laggard than gainer. We'll see how that continues to pan out. Technology catching a bit of attention here this morning. 0.2% in gains there for XLK. Speaking of technology, let's get on over to the NASDAQ 100, the tech-heavy average. We couldn't put all 3,000 plus companies up here, so we gave you a view at the NASDAQ 100. And ultimately right now, it's pretty mixed, almost split down the middle, but you do have some outsized gainers right now coming in the form of Marvell Technologies and then additionally Palantir. Palantir shares, let's see if I can tap into that chart for you here. There you're seeing it up by about 1.25%. And no, this is one of our top trending tickers always on the Yahoo Finance platform, so I'll give you a year-to-date view of that as well, up 65% year-to-date for Palantir. And then additionally Meta, that's also catching some attention this morning. That's up by about 1% to start the day. Pulling up the caboose on the NASDAQ 100 was PDD. Company had just reported earnings yesterday. And taking a look at the Dow Jones Industrial Average. 30 components here. We got it pulled up on the screen, and Apple is leading the pack. However, in the rear, the caboose, whatever you want to call it, down. Amgen, it's lower by about 0.5% right now. Maddie, I'll toss things back on over to you.
Thanks so much, Brad. It's time now for today's strategy session. Strategists at Barclays saying the market's next move will be higher, calling it the path of least resistance as institutional investors sat out the latest rally. So, could strong earnings results spark continued gains? Joining us now to discuss, Michael Rankin. He is Macys senior market strategist. Michael, great to speak with you. I know you were mentioning when you first got to set that at least we've gotten the worst behind us. It seems like there's a little bit more momentum to the upside here, but to what extent can we continue to expect the market to rally as we head out of earnings season and there maybe isn't that much of a catalyst for growth?
Yeah, I think hyper waffling might be actually some foreshadowing for what we might see, kind of in the next couple of months. Look, I think we've had this pretty strong upside, kind of momentum move off of the lows. Really strong, kind of breadth as we saw that. And as we talked last time, we were looking for kind of a test of that 200-day moving average. The last time I was here. We did kind of overshoot that to the upside. Yeah. And then, kind of last week after seeing a 20% rally, we came and kind of pulled back in to kind of retest that level. I think that is a pretty good support level kind of beneath here, 57.75. And then you're looking at kind of a gap from the China détente, kind of just under 5,700. So I think technically we're in for a period of a little bit of consolidation. We have some pretty big potential catalysts as we move through the summer to work through in terms of kind of the tax bill, the 90-day reprieve rolling off. Right, so we'll have to kind of see how some of that plays out.
Sure.
As we're continuing to hear from companies who are talking about where they needed to front run any potential tariff impact here, and also what it's spelling out about their consumer and how they're continuing to navigate this environment, What is the health of the economy as assessed through some of the earnings that we've heard thus far in aggregate over the course of the season?
Yeah, so I mean, I think the last time I was here as well, we talked about this idea of BT and AT before tariffs, after tariffs, right? And I think that Q1 earnings season really kind of solidifies the idea that the economy and kind of corporate America was performing very well, ahead of kind of those tariff announcements during the first quarter. Now we're going to need to see kind of how things progress. Unfortunately, I think there's a kind of a third time period that we're going to have to work through. That's kind of purgatory, as we're calling it, right? Where we're having to kind of work through the pull forward of some of that demand, and start to see what the impact on pricing is, kind of from tariffs and how companies are going to react. So I mean, they've kind of told you, that they're starting to mitigate, finding ways to mitigate some of those cost pressures. I think corporate America has learned from kind of past experience, kind of coming out of COVID. They've really shown that they're very able to kind of quickly and dynamically kind of shift kind of supply chains and kind of react to these difficult environments.
Okay, so that's the company lens. What about for the Fed and the lens that they're assessing it through? Because we're going to get the meeting minutes today. What is the tone that you expect them to have acknowledged at least at their most recent meeting?
Yeah, so I mean, the issue for the Fed is that kind of the potential impact of tariffs kind of puts their dual mandate kind of at tension with itself, right? And they're going to be kind of stuck in this period of time where they need to assess what the impact on prices will be, whether that's kind of a one-time impact. It's going to take a little bit of time for them to do that. They've pretty kind of consistently told you that they're in a wait and see mode at this point, and I don't think that's going to shift unless we see a very, very significant kind of slowdown kind of on the job side of the dual mandate, right? But until we were to really see that, which we haven't seen any signs of. If you look at the claims data, the non-farm payrolls data, right? Nothing's really suggested that has shifted, and until we see that shift, I think they're going to just continue to be in this wait and see stance.
And we talk about earnings, we talk about the Fed, and the reconciliation bill, or the big beautiful bill, excuse me, but mixing up my administrations. But I'm curious about whether or not it really all comes down to tariff policy at the end of the day. We saw the huge move to the upside off of the president's announcement that the EU tariffs were not actually going to be as severe as initially teased out. Is that going to continue to be the driver of significant gains in the near term?
I mean, I think, at this point, markets seem to be a little bit desensitized to kind of some of those trade headlines, right? I mean, on last Friday, when we did get the initial EU headlines, markets sold off a little bit, but I mean, it was a pretty muted response in general. I think there was the idea that we weren't going to actually institute 50% tariffs on the EU. So I think we're getting a little bit desensitized to some of those headlines. The issue would be is if we really start to see those things kind of ramp back up. But it seems that the administration is sort of looking for kind of that off ramp, and it really seems that it's very transactional at this point, where the administration is looking, to do business right around the globe, and it's become kind of this very transactional, in nature.
Sure.
Michael, good to see you this morning.
Thanks for having me.
How's the tone at the NYSE? Everybody okay down there after the Knicks loss?
Yeah, I was going to say, I was a little relieved that we're kind of open around unchanged. Yeah, definitely some downtrodden folks on.
Well, you got to a bright-spirited place over here for the morning at least. Michael, good to see you. Thanks
for having me.
Thank you.
Let's get to three market movers you need to watch for the trading day. Yahoo Finance's Jared Blickery has more. Hey, Jared.
Thank you. I am looking at relentless tech this morning, and we're going to start with the NASDAQ. But before we do that, I just want to tell you, I'm also looking at yields, the continuing saga of the 30-year, and all the auctions we have on deck this week, which are going well, by the way, and got some more on deck. And then also a number of breakouts in a broad swath of industries. We're going to get into some heat map action. So let us start with the NASDAQ. It is leading the day up a whopping 0.25%, so not a lot right now. But let me show you the two-day price action. Yesterday was a really nice day because we broke a losing streak in the Dow and the S&P 500 of 4 days. S&P had bounced off its 200-day, and I was saying the markets look a lot more bullish, and that is continuing today, just a little bit here. So that's the NASDAQ. I also want to take a quick look at the VIX here. Now, the VIX, as I've been highlighting, reached all the way up to 25 last week, and that was kind of a yellow flag moment. But over the last 2 days, it has dropped back below 20, and so we are back in the teens, and that is the relative safety territory. So not nearly as much institutional hedging concerns, and that's what the VIX is, according to Steve Sosnick, not a fear gauge, but institutional hedging proxy. Nothing like the 50 and 60 level that we saw from earlier, just a couple months ago. So things have improved on that front. Now, let me get to the yield situation here, because yields are ticking up, but that's not quite as concerning as it was last week, and that's because they are still below 5%, and also yields are moving in the same direction as the US dollar index. The problem was the whole world was seeming to say, let's sell the US dollar and all US assets, and we're just not seeing that right now. So yields are ticking up. That means people are selling bonds, but still nothing too concerning just yet. 4 basis points does catch my attention. And I did mention some auctions on deck today. We have the 5 and the 7 year. So today's a 5, tomorrow's a 7. The 2 passed with flying colors yesterday. And it looks like the Japanese kind of scaling back on some of their debt issuance has really kind of given a reprieve to the developed world yields. And that's bullish. And now let us take a look at some of all these breakouts we've been tracking, or I've been tracking at least. This is what's happening. These all broke out yesterday. And you can see some of them are pulling back today. And that's normal after a breakout. Tesla down 0.5%, Carnival Cruise Lines down 1.2%. But let me show you the 2-day totals, and the gains that we saw yesterday just dwarf anything that we're seeing in terms of a pullback today. So let's just chart a few of these real quick. Here's Tesla. This is a year to date. Just want to highlight, a lot of these charts look the same. They were consolidating for a couple of weeks, and now they have finally broken out. So Tesla breaking to the upside, still down about 10% this year. Here's Broadcom, very close in market cap. It was consolidating, and it is broken up. And by the way, this kind of looks like the NASDAQ chart pre-breaking out. So we'll have to see if the NASDAQ can break out on Nvidia earnings tonight. And by the way, Nvidia is not in this group. It is still treading water, and that's going to be a big one to watch and a big bellwether. But what impresses me here, let's take a look at GE Aerospace. This has been hitting new highs for the last month, and only a very brief consolidation before it was breaking out yesterday. Also seeing stocks like AppLovin, that's up 8.3% over the last 2 days. JC Johnson Controls, so we got capital goods in there. We've got some, let's take a look at CEG, Constellation Energy, a perennial performer last year. That is broken to the upside. So you put it all together, we've seen a lot of participation in this rally. The internals have been looking good. And if everything goes well with Nvidia tonight, and admittedly that's a big if, maybe we'll be talking about some additional breakouts tomorrow. Guys.
Jared, thank you so much. Appreciate it. Coming up here, Bitcoin hovering just below, just below $109,000 as top officials are heading to Las Vegas for the annual Bitcoin conference. We break down what it means for crypto investors. That's next. U.S. officials, including Vice President J.D. Vance, White House crypto czar David Sachs, and Senator Cynthia Lummis are attending the Bitcoin conference now underway in Las Vegas. Joining us now to break down what the administration's crypto stance means for the broader industry, we've got Brady Dale. He is Axios' crypto reporter. Brady, great to have you in studio here. Just talk to me about what you are hearing from sources about the biggest news that is potentially going to come from the Bitcoin conference this week.
Well, I think it's interesting that today the Labor Department announced that they're backing off their guidance that you shouldn't hold Bitcoin in retirement accounts, and I can't help but feel that that announcement was timed somewhat to this big Bitcoin week. Yesterday, David Sachs talked about all the things the administration has done, and we'll hear from J.D. Vance today. Maybe he'll preview something big for us, but we haven't gotten clues about that yet.
Mm-hmm. When you hear about the roster of people that are coming to speak there, the profiles where we're trying to figure out if crypto ultimately does still need a figurehead around it, or is that something where after FTX, after Justin Sun, after all of those previous figures that had really been pioneers and then also wanted to have their faces be annexed to the entire crypto movement, does crypto need a face of the movement itself?
I don't think it does anymore, and I think what it's going to have if like stablecoin legislation passes is figures like Bank of America and Citigroup as they launch stablecoins, and then we'll see all kinds of things going over blockchains, and we won't need any more Vitalik's at that point. I mean, Vitalik is great and he can still do his thing, but he won't be needed anymore.
Well, talk to me about how all of this nets out, because we're in such an interesting moment for your beat, where there's so much legitimizing of crypto going on with those firms that you mentioned, but then you have the president hosting dinners where the top contributors to his meme coin are invited. Like, where does that net out on how everyday investors might be feeling about crypto as a legitimate asset?
I mean, I think by and large, everyday investors who are leaning crypto are getting more and more into it. I know those of us in the chattering class see a lot of ethical problems with the things Trump is doing, and that's correct. But I think for the average person, it's like the president is buying Bitcoin, I'm going to buy some Bitcoin. I think that's the way it's going. So,
but there is some regulatory pushback as well. I know that you've written about Maxine Waters' Stop Trump policy, for example. What are your thoughts on that legislation having an impact?
I think crypto legislation will get through, but if Trump hadn't have launched a meme coin and his own stable coin through the company World Liberty Finance, I think the stablecoin bill would have been passed by now. He's just really given a lot of ammunition to the Democrats who want to make a point about problems with the Trump administration. He's made it pretty easy for them to make that point, and so it has definitely slowed down the stablecoin legislation. I still expect it passes, but it's harder, and they're going to get more compromises out of it because of the moves the White House has made.
So should investors feel comfortable buying into companies that are basically implementing the MicroStrategy, formerly MicroStrategy, now strategy, if you will, which is just hold a bunch of Bitcoin on your balance sheet, as is the case for DJT now, announcing their offering to buy more Bitcoin and to hold on to that, as is the case with GameStop as of this morning.
You are anticipating the question that I plan to work on later today when I leave the studio. But I think the thing that investors should look at on those stories is if a company is just buying some Bitcoin with its extra money, I mean, that may or may not be the best strategy for it, but probably no harm. If they're buying it on leverage, watch out. Because if they're buying it on leverage, there is a price at which if Bitcoin drops enough, and we know Bitcoin has a way of dropping in price.
That they're major sellers of it.
Yeah, then there'll be margin calls.
Right.
And there could be big dumps of Bitcoin. Right. And I don't think that'll kill Bitcoin, but I don't think that'd be great for an investor's portfolio, especially if you bought a heavily leveraged stock.
Brady, about a minute left here, but just wanted to get a chance to get your thoughts on this crypto investor who was charged with kidnapping and torturing in New York City. I'm just curious, is that something that leads to a little bit of poisoning of investor sentiment around crypto?
Well, no one wants to be kidnapped. I mean, this is the dicey thing about crypto, right? It's it is a bearer asset, so if you can get your hands on it, it's hard to get it back. And that's not the only recent kidnapping we've seen. So I guess my advice to your viewers, if you're going to buy a bunch of crypto, don't advertise that to the world. Don't let everyone know, especially if you're holding it yourself.
Yeah.
Brady, good to see you. Thanks so much for taking the time.
Thank
as
you.
Always.
Thank you.
Definitely. We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief.
Tesla CEO Elon Musk might be stepping back from Doge, but he's not staying out of politics entirely. Musk telling CBS Sunday Morning he is, quote, disappointed by the price tag of President Trump's big, beautiful bill. Republicans in the House passed the Trump-backed tax bill last week. The legislation now heading to the Senate. The bill extends Trump's 2017 tax cuts, creates temporary tax cuts like no taxes on tips or overtime, increases the SALT deduction cap, and boosts border security spending and mandates work requirements for Medicaid, among other things. In an interview set to air June 1st, Musk telling CBS, quote, I was disappointed to see the massive spending bill, frankly, which increases the budget deficit, not just decreases it, and undermines the work that the Doge team is doing. The tax provisions are expected to increase the deficit by $3.8 trillion by 2034. That's according to the Congressional Budget Office. Musk also saying, quote, I think a bill can be big or it can be beautiful, but I don't know if it can be both. The comments come as Musk pledges to significantly cut back his role at Doge amid widespread criticism, particularly in light of Tesla's recent performance. The stock down 10% so far for the year.
Big three automaker Stalantis, owner of brands like Jeep, Dodge, and Chrysler, is appointing a new CEO after a months-long search following the surprise departure of former CEO Carlos Tavares. Here with more details, we've got Yahoo Finance senior autos reporter Pras Subramanian here. All right, Pras, take us into what you've been able to evaluate on this.
Yeah, Brad, it took 6 months for them to name an insider, which is interesting. But yeah, Antonio Filosa, former Jeep head, current America's COO, a 25-year vet of the company, now the new official CEO of Stalantis. So he was sort of, the writing was on the wall that an internal candidate like him might have been selected, and he was there. But, it seems to be a good fit based on his background and based on the brands that he worked at. Now, some of the challenges he faces, a big part of the problem last year was inventory. They had bloated inventory. They've been kind of selling that down, but that's going to hit margins because of the price cutting. He has to sort of right the ship there, introduce more products that people want that don't require huge discounts. There's also the ongoing labor disputes of the UAW. They have their new deal in place, but factories like Belvidere in Illinois, where they make some Jeep products, have been idled for a couple of years. There's a lot of resentment there between the UAW and Stalantis about some say unfairness or a lack of honesty with regards to what's happening there. He has to sort of fix that as well. And of course, tariffs, right? Tariffs are ongoing there. They're affecting the company. 25% tariffs on products from Mexico, Canada, and Europe, where Stalantis is based. A lot of those products are coming in from those regions. They have to figure out how do we boost North American production and things like that. And also, of course, EV strategy. How do you get that in place here in the country where EVs are still selling highly, but kind of coming down a bit, and the EV tax rate is sort of under threat. So we'll see what happens. But a lot on his plate right now for Antonio Filosa.
Yeah, and Pras, just about a minute left. What is Wall Street's reaction to the pick so far?
Because of the fact that the pick was sort of expected in some regard, we knew that he was a potential candidate. You're seeing the mixed reaction there, a little down 1%. Nothing too crazy there for Stalantis. You would pick the big outsider. You could have seen a big pop in the stock, but I think the board kind of feels that an insider right now might be the best choice, considering the company is under a lot of transformation.
All right, Pras, we got to leave it there. Thank you so much.
Thank you.
That's going to do it for the morning brief. You can join me in the next hour for more analysis on catalysts, and then Brad will have you for wealth after that. Stick around.